Dan, thanks for joining us today.
Thanks for having me.
It's interesting times in bond land. We've had this dynamic over the last 2 or 3 months in the US bond market where long rates have surged. And then we had this period very recently where we saw a sharp decline. What do you make of that dynamic? And are we in a bond rally?
Well, we've been in a bond rally a good portion of last week, but last week doesn't quite make a trend yet. Inflation's still a problem. A tremendous amount of geopolitical uncertainty around the globe. Pretty challenging supply technicals. So we're going to be in a volatile environment. I think the good news is that value's back in bonds. Whether you look at nominal returns or real rates, we haven't seen this value now in well over a decade. So I think value is a big advantage, and I think this higher coupon income over time will add up. But expect a lot of volatility in terms of absolute rates, volatility across the curve. So investors need to be patient and have a bit of a longer term horizon or a little bit of patience with this market. But we're more confident than we've been in a long time that investors, either moving from cash into fixed income or from equities into fixed income, will be rewarded with some pretty good returns over the next 2 to 3 years.
Am I hearing that you're saying now's the time to invest in bonds?
Well, I'm not necessarily calling the high end rates again, given uncertainty, but yes, we do think it's a pretty good time to begin to shift some of your allocation back into fixed income. I know it's been a real rough 2022. This year has been quite volatile, but again, given this sell-off, we do think value's back. And a big advantage in fixed income is it's not that complicated over a few year horizon. Typically, you earn your starting yield. Correlations between forward returns and starting yields are up above 90%. So investors today can lock in 6, 7, 8, 9% in a pretty high quality bond portfolio, not take a lot of interest rate risk. And I think they'll be rewarded by doing so, at least with that 2 to 3 year horizon.
Where, we have a pretty flat yield curve right now. Where on the yield curve should investors be, or where should they be thinking about?
Yeah, well, we don't think you need to take a tremendous amount of interest rate risk to generate attractive returns. So in our income strategies, some other Pimco strategies, we are in what we'll refer to as the belly of the curve. Somewhere in that 5-year maturity range. Even 2 to 3 year maturities look quite attractive as well if you want to be a little bit more insulated from some of the more recent volatility. So bottom line is stay in those shorter maturities. We're a little bit underweight the extreme long end, a bit concerned about long-term debt sustainability issues and supply technicals, but you can hunker down a little bit, play a little bit of defense, and again, generate those, type of, high single-digit returns that I talked about earlier.
Do you think that we're going to see a recession in the United States in 2024?
We think there's a good chance. Our recession probabilities, given more recent data, are right around a coin flip. So we do think there's a elevated risk of recession. And again, the good news there is that you can be resilient. You can underweight some of the more economically sensitive areas of the market, go up in quality in areas like agency mortgages, AAA type asset-backed securities risk, investment grade corporate bonds, even up at that single A rating level, and reduce the risk of bad outcomes if we do have that recession. So we do think the recession probability next year is a little bit higher than what's implied by the markets or some of the popular forecasters out there, but it's not a guarantee either. There's a lot that this economy has going for it, pretty strong growth and employment momentum. Key segments of the market like the household or the consumer are holding up real well, but we do expect to see some steady weakening in terms of growth. And when you combine that with all this geopolitical uncertainty, investors should be prepared for a recession, even though it's not guaranteed to occur. That's exactly what we're doing across portfolios, including the income strategy.
Should they be prepared for a hard landing?
They should. And again, there's a good chance that if we have a recession, it will be a relatively shallow recession because there's so much momentum within the economy and some key segments of the market remain quite healthy. But again, anytime you have central banks taking interest rates up as quickly as they have with inverted yield curves, and again, lots of political uncertainty, lots of geopolitical uncertainty, investors should at least prepare for hard landing scenarios, even if it's only maybe a 33% type chance, 25% chance that we have something that feels, real hard relative to what we've grown accustomed to. And again, the great news is that you can prepare for a hard landing in the fixed income markets, not take a lot of risk that's very economically sensitive, and generate those types of returns that I talked about. There'll be a time probably next year in the face of some more economic weakening where investors can go on the offense more aggressively. But we think right now, trade off a little bit of resiliency in a portfolio, a little bit lower yield, but still hit those type of returns that I talked about earlier.
Where are we, Dan, with inflation then? From my seat, it still feels pretty sticky. Obviously, prices have come down, but still feels sticky. But I really want to know what you think.
Well, the inflation numbers have been constructive. We're well off the peaks on a global basis. Here in this country, inflation's moving in the right direction, but it's still well above central bank targets. We think there'll be more progress on the inflation front, but I think we'll be above central bank targets well into 2024. So the war against inflation hasn't been won yet. We think central banks want to be patient. They want to keep rates up here and see if they've done enough. But if inflation remains sticky to the upside or reaccelerates, central banks will take rates higher again. So again, good news, but again, a bit more work to be done. Another reason why we think good old-fashioned inflation-protected securities look real good here. Real rates or inflation-adjusted rates are the highest we've seen, again, in well over a decade. These break-even inflation rates that we refer to are still relatively low. So there's a little bit of, for everyone in the fixed income markets, if you don't buy into the idea that inflation is going to continue to make progress, you can buy protection from those scenarios and still achieve, very, very high returns. In our income strategies, for example, even though we're constructive on inflation, we own a very, very healthy allocation to inflation-protected bonds. We think they make a lot of sense in a portfolio. Buy a little bit of insurance against inflation remaining higher for longer. It's certainly quite possible.
What kind of duration on those?
We own some very, very front end inflation protected securities, 1 or 2 year maturities. And then we have a healthy allocation, out the curve in that 5 to 10 year maturity bucket as well. We own those for slightly different reasons. That front end position tends to be an expression around short-term inflation, even what may happen with commodity prices. So we think they both make sense for slightly different reasons. Bottom line is, look to provide a little bit of protection against these inflationary type scenarios to help buffer volatility, across a dynamic strategy and a broad strategy like our income funds. Our total return strategies also own some inflation-protected securities as well.
The market seems to be pricing in cuts from the Fed sometime around the summer of 24. Do you think the market has that right?
Well, we think it's certainly possible. And the Fed has said that if they see further progress on the inflation front, even though it is above their target, and they see some further weakening in the economy, they will potentially reduce interest rates back down to a less restrictive level. I think what's priced in the very, very front end of the curve may be a bit optimistic, especially after the rally we saw late last week. But we do think that it's quite possible that in the face of slowing economic growth, we see some cuts by the Fed at least later in 2024. And again, they've been very, very clear in saying that they don't need to see inflation back to target before easing policy. So it's certainly possible. But again, investors don't need to bet on those outcomes to, again, achieve, pretty attractive returns, given the absolute level of rates and the current curve positioning.
Do you think if we do have a recession, you're saying it's a 50-50 coin flip, that the Fed might be in a box? In other words, where they, ease into a recession, but then bond rates still go higher. And then I think about what does that mean for, U.S. fiscal policy and for the Treasury?
Yeah, we do it. And I think both the Fed and Congress may be in a box. And this is why, we do think you need to prepare for hard landing type scenarios. Our models, other models that have been challenged in this environment, suggest that any type of slowdown may be softer, more mild. But you got to be careful with that mindset. You have an environment today with inflation quite elevated, with us running big deficits in this country despite a strong economy. And I don't think I need to convince anyone, significant gridlock in Congress. So if you do have a period of economic weakness, if you have additional growth shocks, perhaps of the geopolitical variety, central banks may not be there like they have been during prior slowdowns. You may not get that fiscal response that market participants have grown accustomed to. So that's one of the reasons why we don't feel comfortable relying on models alone. I think you have to prepare for a situation where the economy slows and you don't get that support that we're used to. And that could mean a more protracted recessionary environment. It could mean that markets just get scared and they overshoot fundamentals, which will be a great buying opportunity. Again, one of the reasons why we have a lot of liquidity or flexibility across the income strategy and other Pimco portfolios, because that scenario that you hint at is certainly quite possible. And when you combine that with a little bit of panic or fear, which it tends to happen when you need a little bit of fiscal monetary help and it doesn't come, that could be a great time to shift from more of a defensive mindset to offense. And that very well may be what 2024 is all about.
Well, Dan, thanks so much for taking some time with us today. It's been really, really interesting.
Thank you. Appreciate the time. Always enjoy it.